Good afternoon. This is Craig Moddelmog of Cornerstone Wealth Management, and I would like to welcome you all to this week's Wall Street X's and O's. It is Friday, November 22nd. We are a few days out from Thanksgiving. Today in Fort Collins, we have a little bit of snow, feeling like winter. I love it. My hope is the mountains are getting some because I'm ready to go skiing. Anyway, getting on with what's going on today. You know, it always seems around the holidays where you hear about lots of scams, whether that be internet related, email related. One I'm going to focus on today has been really phone calls that people are receiving. Year to date, actually this goes through October, the Federal Trade Commission reported almost 150,000 complaints of scams involving the Social Security Administration imposters. That is just Social Security Administration imposters. That is crazy. And sadly, they are reporting losses from these scams totaling almost $30 million. What I want to relay to you is this. The federal government, the IRS, nobody is going to pick up the phone and call and ask you for personal information or anything or tell you anything about what's going on with your account. Specifically your Social Security, your bank accounts, none of that. You're going to get a formal letter in the mail. It's going to be a formal process. So do not fall for that junk. On the email side, really look at your email and look at the address on where it is coming from, whom it's coming from. If you're getting something where they're saying, hey, you should click this link and check your account, don't ever do that. You type in the link yourself and go there yourself. So just a few little safety tips as we enter the holidays, because I know it's a wonderful time of the year. It can also be kind of stressful, and sadly there are a bunch of schmucks out there that are trying to rip people off. That's terrible. Anyway, moving on. Looking at the markets, here's some interesting stats for you. You know I'm a stat guy. In January of 2018, okay, that's almost 2 years ago, the S&P 500 peaked at 2,870. 2870. In September of that same year, so September of 2018, it peaked out again at 2940. That is a gain of 2.4%. That was a high for 2018. If you'll remember, then the markets tanked. Terrible. Fourth quarter of 2018 was a stinking train wreck. We have then seen the markets recover in 2019. We've hit three separate highs, I think. I want to get this just so I am quoting specifics here. We've set three highs this year. And the most recent one was in November, and it hit 3,127, okay? That is a gain since the previous high in September of 2018. So we're looking at 15 months away from that. See how I count with my fingers? See, you can really tell this is uncut and unedited because I'm counting with my fingers. At least I don't have a calculator out here to count from September of 2018 to November of 2019. Anyway, 15 months, that is a gain of only 6.3%. If you go back to January's high of 2018 through our high here recently in November, that is a total return of only 8.9%. That does not include dividends. So that is pure price appreciation of the S&P 500. That is not a big move. The markets feel like they're up a lot this year. You know why? The markets got killed in Q4 of 2018. So don't think you're making a ton of money this year, because if you go back for the last two, we're really not, okay? If you go to the bond market, here's another very interesting fact. The 10-year Treasury bill peaked back in February of 2018. Notice some similarities there at 2.94%. We then saw it go up and hit a high, an all-time high in October of 2018 of 3.24%. What happened there was we got into 2019. We saw the Fed cut rates 3 times. We saw a lot of fear return to the marketplace, and yields in the 10-year Treasury dropped to 1.42. Okay, that's a big stinking move. That is a 50% reduction in yield. That is massive. Okay, in July of this year, if you were going to go look at total return or performance year to date, you know what the number one performing asset category was in July? No, equities, you're wrong. You were wrong. It was long-term Treasury bonds. Crazy, I know. Here's the thing. Very interesting times, okay? That's an obvious. We got lots of stuff going on with China trade. We have a very interesting political spectrum, of which I'm not going to get on my soapbox, or this would be a stinking 15-minute video instead of a 7-minute video. And I know you're thankful for that. So what am I looking at is this. We live in a world where $15 trillion of the world's debt is at a negative interest rate. That's stinking insane, okay? That is, I'm going to buy a bond and I'm going to actually make no money in interest. I'm going to lose money on it. And I'm praying that this bond appreciates. That's crazy. 15 trillion of that debt, 1.5 with trillion behind it. That's big, okay? I think the market is going to hang in there at this point in time. If you look historically after the third rate cuts, markets tend to be pretty positive in what they call a short easing cycle, which the Fed has only reduced rates 3 times this year. That would be classified as a short easing cycle, because the Fed has basically come out and says, you know what, we're not going to reduce rates anymore. The economy's doing okay. We're really going to hold in there and really look at the numbers, which I'm thankful for. They've done a great job. In short easing cycles without a recession, key 2 words, without recession, markets have been especially bullish over the next year. Now, and is that Craig anticipating we're going to have a fantastic year in 2020? No, I'm just saying from a historical standpoint, whenever the Fed has gone on a short easing cycle and we have not gone into recession, markets have been good, okay? So I tell you what, as we go into this Thanksgiving holiday here, first of all, I would like to say that we are going to continue to stay focused on the fundamentals of the market. We're going to continue to stay focused on high quality. What does that mean? High quality stocks that pay dividends and high quality bonds. That doesn't mean bonds with a low credit rating. So we're really continue to have a quality rules the day focal point. In closing, I would like to wish everyone a fantastic Thanksgiving. I know my kids are flying home next week. I can't wait to give them a big bear hug and spend some time with them. I hope that you all really enjoy some good quality time with your families. And until next time, this is Craig Moddelmog with Cornerstone Wealth Management for Wall Street X's and O's, and I am out.